Financial Crisis Inquiry Commission on which I served reported, this enormous unregulated market was a significant cause of the 2008 financial crisis. These instruments fueled the housing bubble and significantly amplified the catastrophic losses caused by its collapse. They caused the near failure of AIG and required the federal government to commit more than $180 billion to its rescue in order to prevent losses to its counterparties, which threatened to bring down the entire financial system. The 2008 financial crisis has caused the loss of millions of jobs, millions of foreclosed homes, and trillions of dollars of lost household wealth. It is imperative that we try our best to avoid a repetition of it. The Dodd-Frank Act reforms authorizing the CFTC, along with the SEC, to regulate the over-the-counter derivatives market are designed to prevent a recurrence of the financial crisis by bringing transparency to this dark market through exchange trading and by reducing the risk of counterparty credit risk and contagion through central clearing. These reforms are vital to reducing systemic risk and must be implemented. The CFTC is desperately in need of additional funding. It currently has only about 10% more staff than it did when I was chair of the CFTC in the late 1990s. The CFTC staff was stretched thin even then, yet its responsibilities are so much greater now. Today, the exchange-traded futures markets have increased fivefold from the days when I was at the CFTC. And more importantly, the CFTC now has responsibility to impose a regulatory scheme on the much larger over-the-counter derivatives market for the first time. The House Appropriations Subcommittee's failure to increase the CFTC's budget to reflect these increased responsibilities, and indeed its irresponsible proposal to cut the CFTC's budget by $25 million, are efforts to eviscerate vitally important financial regulatory reform and to cater to the interests of Wall Street rather than the needs of the American people. They would severely impair the CFTC's ability fully to implement and enforce the Dodd-Frank Act's provisions and would leave us all more vulnerable to financial crisis. The failure to regulate over-the-counter derivatives has already cost the country so much. We must learn from this tragedy to avoid repeating it. The CFTC should be fully funded as requested by the President. Thank you.
Very well said. Thank you very much. We will also be hearing later, there's a lot of talk about protecting the end users, and Mr. Guilford, who represents important end users, will speak. But next, one of our leaders in this effort to, as he says, to keep the referees on the field in this very important game, fight, unfortunately, is our Democratic Whip, Steny Hoyer.
Thank you very much, Barney Frank, who has been such an extraordinary leader in the effort, as I say, and he quotes me, as putting the referee back on the field. And I want to say how proud I am to be here with Brooklyn Bourne. You know, there are people who anticipate problems and who speak out. And it is extraordinary that some very, very bright people on, frankly, both sides of the aisle said, no, we don't need to do that. The derivatives are doing just fine. Brooklyn Bourne was right, they were wrong, and frankly, I was wrong. I voted for legislation which said that that didn't need to be overseen. I was wrong. I don't think we need to make that mistake a second time. When crisis struck our financial systems in 2008, it wasn't because there was too much regulation. Let me repeat that. Our crisis struck not because there was too much regulation. For years, the Bush administration and the Republican Congress took the referees off the field when it came to Wall Street. Thanks to the reform legislation we passed last Congress, which was led by the ranking member, Barney Frank, at that time chairman, Barney Frank, we gave the SEC and the CFTC the tools they need to prevent another crisis from recurring and causing taxpayers and American people so much pain. It is not time to call retreat on that effort. It is not time to go backward on that effort. It is not time, as I say so often my Republican friends do, to walk away from our responsibilities. The appropriation bills released this week to fund these agencies would hinder this work and walk away from this commitment. By funding both agencies below the President's requested levels and the CFTC below the 2012 levels, Republicans are trying to hamstring the sensible regulation of Wall Street banks and of our common trading. That siren sounds the emergency that we need to make sure that we respond to this effort to undermine protections of the American people. The Republicans want to bring us back to the days of under-regulated financial markets and the conditions that led to the Wall Street bailout. They want to make it easier for speculators to drive up the price of oil, which will mean Americans paying more at the pump. Former CFTC chairwoman who has spoken to us, is here with us, warned us in the 1990s that a crisis was brewing because of insufficient oversight. She's here today to warn us again, as she has just done, that if we erode the SEC and CFTC ability to do their jobs, we will find ourselves back in the same place we were in 2008. No one wants to be there. Let's not allow that to happen. Let's not risk another Wall Street bailout. Let's not let gas prices rise for working families because the CFTC can't do its job. I'm calling on my Republican friends to let these agencies carry on their important work. They're already being asked to do more with less. The savings Republicans claim to be reaping from these cuts are minuscule compared to the damage they will cause to our economy. Let's give the SEC and the CFTC, watchdogs, the tools they need to prevent market manipulation and prevent another bailout. I applaud Barney Frank, Brooksley Born. I applaud you for your efforts in the past that continue today to make sure the referees stay on the field, because when the referees are taken off the field, the little guys get trampled. Let's not do that.
Now we have two other groups who we've talked to. One, our agriculture subcommittee leaders in trying to get these funds restored, and then there'll be some specific focus on the impact on speculation on oil prices. But let me now call on Sam Farr, because this bill will be coming to the floor, and Sam Farr in the agriculture subcommittee is a ranking member, and again on the floor will be leading our fight to get the relatively small amounts of money in federal budget terms that we need for the CFTC to begin to do its job.
Thank you very much, Barney. As stated, I'm Congressman Sam Farr, Democrat from Carmel, California, and I serve as the ranking member of the Appropriations Subcommittee on USDA, FDA, and CFTC. It's our committee's responsibility to appropriate the funds necessary to carry out the law. The Dodd-Frank created for the first time consumer oversight, heretofore never regulated derivatives and swaps. The market has grown, as was stated, to over $300 trillion in the United States and another $100 trillion in international activity. The law requires the CFTC to provide oversight for our markets through greater transparency, through openness and disclosure. New rules have been written, but the Republican leadership will not allow the hiring of employees to enforce the law. Commissioner Gary Gensler told our committee that without the funds, the commissioner doesn't have the capacity to even register the participants, much less enforce the law. To cut the president's request for CFTC by 41% is unconscionable. It's designed to cripple the CFTC, and as the chairman indicated to the committee, that it would be like expanding the NFL to 100 games a weekend, but without hiring any new referees. The Republican cuts amount to about 1/10,000th of 1% of the 300 trillion swaps market. That's 0.00001%. The president's ask isn't that much money, but without it, it can cripple the regulators. Make no mistake about this. The swap dealers don't want it to be regulated. The market is as much as 20 times the market the SEC oversees. By the way, there are more cops on the beat with the SEC, and still they don't have enough. They have enough struggles with oversight. The fact that the CFTC budget request boils down to equivalent of 6 seconds of trading for the $400 trillion global market that operates 24/7. Yet what happens when a giant bank like JP Morgan has enormous losses, as they have reported just 2 weeks ago? Who steps in to investigate? The answer to that is the CFTC. How well can they do their oversight responsibilities without staff? The Republicans have linked up to make sure that the new greed is protected from regulation. Consumers, investors, and other financial interests need protection. Congressman, the Congress passed the Dodd-Frank wanting to see things work and to give some trust to the market. The legislation is too popular to repeal, but one can kill it by not funding it. It's a death by 1,000 nicks. We are here to restore the people's confidence in government regulators by restoring the funding that the president asked for. Thank you, Barney.
Next, the chair of our Democratic caucus, who's been very concerned about the impact on the consumer here, John Larson.
Thank you, Barney. Thank you for organizing this morning. What an honor to be here with Brooksley Born, and also a colleague of Rosa DeLauro's and mine, and someone who has been in the forefront of the fight to make sure that we restore some semblance to supply and demand. Gene Guilford, who is served in the Reagan administration, both in the Department of Commerce and the Department of Energy, who he'll be serving from shortly. So, what do we have here? What we have is the confluence of money on steroids during an election time with all of its ugly influence. How so? Well, if your goal is to shrink government up so small you can drown it in the bathtub, you're witnessing the drowning of government. Who does it impact? It impacts all of the people in this country whose mortgages are underwater. That's who the victim is in this instance. That's why we needed the reforms in Dodd-Frank. That's why we need to return to a period of time that Gene Guilford will talk about when regulations mean something. It used to be that we were concerned that it was the foxes guarding the henhouse. Now we are simply throwing the American people to the wolves. This is a devastating cut. We have to return to make sure that we have regulation in this vital area. Thank you so much, Barney, for organizing this.
Next, we have just a couple more. Rosa DeLauro from Connecticut is a member of the Agriculture Appropriations Subcommittee and actually offered the amendment, which was unfortunately defeated, to restore the funds, and it's a fight we will be renewing in full committee and on the floor.
Thank you very much, Barney, and I'm pleased to be here with Brooksley Born and with Gene Guilford and with all of my colleagues who have been a champion in one area or another that has to do with the work of the CFTC. I think, let me just try to put a fine point on this, because my colleagues have talked about a lot of the details. This is an intentional desire to set up the CFTC for failure. That is what this is all about. And I want to give you a byplay in the committee yesterday that I think demonstrates this. I had the honor of introducing that amendment yesterday. And the chairman of the committee said that Commissioner Gensler of the CFTC said that he could put out the rules and the regulations that Dodd-Frank requires without the extra money. That's what the chair of the committee said, that Mr. Gensler said. And then he said to the commissioner, the rules and the regulations are not out. This is about impugning the validity of the agency to want to do the job, but not the issue of not having the resources to be able to do the job. Now, what I did, and bear with me, it'll only be a second, I went back to find out what, in fact, Mr. Gensler said at that meeting last year. 2012 staffing level, 710 FTEs. The agency is but 10% larger than our peak in the 1990s. But since then, the futures market has grown to approximately $37 trillion notional. Congress added oversight of the 300 million swaps of the market, which is far more complex than the future markets. It is as if all of a sudden the National Football League, the NFL, expanded 8 times to play more than 100 games in a weekend. I think we'd all agree that the same number of referees could not monitor all those games, and that the referees on the field do more than call penalties and watch the violations of the rules. They protect the players, they promote fair competition, and they ultimately ensure the integrity of the game. That is what the commissioner of the CFTC says. He cannot do his job with what the House Agricultural Appropriations Committee wants to provide him with. It is a 41% cut below what the president says. It is irresponsible, it is reckless, and it is about setting up this agency to fail. We are not going to let it happen.
Just to carry on the sports analogy, which you have to expect when members of Congress come together, the CFTC is being double-teamed, and the consumers, because in addition to the underfunding, we have an industry that floods them with comments, which by law they have to carefully consider, and then takes them to court. They are now in court over trying to put on position limits, and you're about to hear about the importance of those. So they have to be very careful. So they are slowed down in adopting the rules by not having enough people, and then having a very painful process that they have to go through under the Administrative Procedures Act to be able to defend it in court. Brooksley Born has justly gotten praise for having been one of the earliest people to say don't do this. Another one who was out there early on, at a time when he was on the subcommittee that had jurisdiction before they changed it, was my Massachusetts colleague Ed Markey, who was also, at the same time as Brooksley Born, warning about the lack of regulation of derivatives, and it's been in particular concerned about the impact on consumers. So our next speaker is Congressman Ed Markey, who is the ranking member of the Resources Committee.
Thank you, Barney, so much. This year, the Republicans gave the CFTC just $205 million, far below the $308 million that the president requested. This week, the House Republicans released their fiscal year 2013 agricultural appropriations bill, and that bill, the CFTC receives only $180 million, $128 million below the president's request. Instead of increasing the CFTC oil market enforcement and surveillance staff sixfold, as the president requested, it will effectively deep six their mission to patrol Wall Street. In 1988, at the height of the insider trading crisis, as I had to rewrite the insider trading law, which is still on the books, Vosky, Levine, Siegel, all these names were famous. And so what I decided to do was ask Levine to come down from prison into my office to tell me what I had to know about the drafting of the insider trading law. And Levine said to me, there was a culture that had been created on Wall Street. People thought they could get away with it. People thought there wasn't a cop on the beat. And as that culture spread, more and more people thought that they could get away with it. And I said to him, what is necessary? And he said, it is critical that people believe they are going to be apprehended. It is critical that people believe they're going to be caught. And what the Republicans are doing is voting to take the cops off the beat. Because one thing that happens over and over on Wall Street is, on the way up, the big guy cleans up. On the way down, the little guy gets cleaned out. That has happened over and over again, generation after generation. Wall Street is incapable of policing itself. The invisible hand of Wall Street market has waved off concerns, waved off regulations, and then reaches into our pockets and takes our money. We need tough new regulations that Barney Frank, in his legislation, has called for. They do not want those new regulations. We need tougher enforcement and more people on the beat. They are now in the Agricultural Committee making sure that that money is not there. To put the fear of being apprehended into the hearts of every one of these potential abusers of the markets. Today, as Brooksley said, corporate cowboys are trading derivatives worth more than 20 times the value of the entire U.S. economy. And this bill is just going to return us to the Wild West in the wake of that corporate crime spree. The Republican solution is to fire 10% of the cops that are on the beat to police this market. In 2008, when the financial house of cards built by Wall Street came crashing down, companies didn't even know their full exposure to the derivatives market. The experts at Lehman Brothers ended up looking more like financial laymen, unable to track, contain, or account for the disintegration of people's pensions, investments, and mortgages. As Barney said, in 1993 and 94, I had 5 hearings, a GAO report, and introduced a bill to create the transparency in the derivatives marketplace. That bill would have passed in 1995. And Brooksley Bourne would have had the authority at the CFTC to oversee this marketplace. But Newt Gingrich took over as Speaker. The Republicans took over the United States Congress. And they would have no hearings on this subject at all as long as they reigned. And then that crude oil casino, that Wall Street casino, was created. So what we're seeing is in the oil marketplace that from December to February, Wall Street speculators turned the oil markets into a crude oil casino, running up the price of oil by 17%. And then in May, the price fell back down to earth by 20%, even as market fundamentals remain strong and relatively unchanged. So what has happened since the financial meltdown? Under the leadership of Barney Frank and President Obama, Democrats passed the badly needed Wall Street reform, but without funding the CFTC, it will not be equipped to oversee these markets. That's the Republican grand plan, and it has been for a generation. Wall Street banks like Goldman Sachs are trying to cut off the reform, and what we are seeing is that the price of oil just rises and falls as the Wall Street firms take bigger and bigger positions in that marketplace, regardless of the impact that it has upon the users, the trucking firms, the airline industry, and others who need it for their industries. So Rosa and Barney and I have written to the Appropriations Committee. We're fighting to block the GOP's technical amendments, and we're working to prohibit the worst practices of Wall Street speculators, like halting index trading of energy commodities that Barney and I and Rosa have introduced to ban gasoline gamblers from energy speculation funds. All of this is necessary. All of it's being opposed by the Republicans, and this is something that has to become a central part of this presidential election of 2012. And I thank you, Barney, for your great leadership.
We'll get to questions shortly, but there's been a lot of talk on the part of those trying to block the regulations about the importance of protecting end users. The financial speculators try to hide behind the end users. There are 2 aspects of this problem. One is the systemic risk that was caused by AIG, an unregulated derivative speculator. But there is also the impact on the consumers from speculation. Most recently, we've seen this in the price of energy. And so we are glad to have with us, John Watson referred to him as someone who had served in Republican administrations. Gene Guilford is the head of the Independent Petroleum Dealers of Connecticut. He's an end user, and he's going to talk to you about what this means when the CFTC is unable to deal with this issue.
Thank you very much. Thank you, Congressman Frank, and other members of Congress in Brooksley Bourne who are with us here today to talk about the important issue of making sure the Commodities Futures Trading Commission has an adequate budget to do its job. Before I talk about end users, I'd like to remind everyone here that it was just 4 years ago that the Secretary of the Treasury, Hank Paulson, and the Federal Reserve Chair, Ben Bernanke, came to meet with several of the people who are with you here today to tell these people that if they didn't pass a piece of legislation within the next couple of days, the financial system of this country would collapse and the American economy would go off a cliff. Now, this Congress and the President took everyone seriously when they delivered that message. The end result of which ultimately was the passage of the Dodd-Frank Financial Services Reform Act. Well, if anyone on the Appropriations Committee had ever been a mayor or a town manager, the last thing that you would do when a crime was committed in your community would be to cut the size of the police force by 25%. $16 trillion of national wealth was wiped out. $12 trillion was spent, lent, or guaranteed by this government to make sure that the financial system of this country did not fall off a cliff. Wall Street has taken America for a joyride. And we've seen it most recently with gasoline prices. Everyone here who drives a car understands exactly what I'm talking about. Between the middle of December and the end of March, the Wall Street gasoline contract went up 92 cents a gallon. 92 cents a gallon, it went up in a straight line. That's $10 billion a month passed on to the American consumer. And why? Did it have anything to do with supply and demand? No, it did not. American consumers have been reducing their demand for gasoline over the last 4 years, 2.5% last year alone. Talk to the Department of Energy's Energy Information Agency and you will find that the gasoline inventory is at its highest level of the last 5-year average. We have plenty of gasoline. Demand is down. For the first time in 62 years since Harry Truman was in the White House, America is a net exporter of refined petroleum products. And yet, $10 billion a month it costs the American consumer. So frankly, some of the folks in this building are asking the wrong question. It isn't whether or not regulation costs the economy jobs and money. It is the absence of regulation that has cost America jobs and money. And it's exactly the reason why the Commodities Futures Trading Commission has to be allowed to do its job. Congressman Frank is absolutely right. All of our consumers that we serve, who paid more than they needed to, whether it was for electricity or natural gas or oil or gasoline, in large measure did that because of the speculative influence that has occurred in Wall Street for the last decade that Dodd-Frank was designed to stop, but that the Commodities Futures Trading Commission could not finish its job on just one rule alone, the position limits rule. They received more than 15,000 comments. And then as soon as the rule was enacted, 2 associations of the financial services industry sued them in federal court to block the rule's implementation. And then they come to Congress and complain that the process is too uncertain and too slow, when they are in fact the ones that are causing the uncertainty and the process to be slow. There is nothing more important than making sure the Commodities Futures Trading Commission can do its job. It's a little tiny agency of 600 people. And to the extent that they are criticized for not having done more with respect to J.P. Morgan Chase, stop and think of one thing about J.P. Morgan Chase. The notional value of their derivatives book of business is $70 trillion. $70 trillion is equal to the size of the economies of the entire planet. The least we can do is to make sure that this little tiny agency has $300 million with which to do its job to protect the American people and the American economy. And I want to congratulate all of you for being here today and thank you for your leadership on this issue.
Thanks to Mr. Guilford, who made an effort to be here. And our last speaker, and we will then be throwing this open, is Representative Jerry Connolly from Virginia.
Thank you, Barney, and thank you for your leadership. To me, this is not a complicated issue. It's very simple. The action of the subcommittee, the Republican majority in the subcommittee, is a reckless and willful attempt to screen their big money donors from any further accountability and transparency, especially with respect to the derivatives market. And there's one question every American should ask. Given the meltdown that occurred in 2008, given the fragility of the world economy right now, given the fact that so many European banks hold too much European sovereign debt, given our recent economic performance numbers, when you look at a market that is valued, as Bjorn said, in excess of $600 trillion, unregulated, with this action, what could go wrong with that?
We will now be glad to take questions, if people have them, from either the experts or the members of Congress. You can choice facts or rhetoric. You can pick the, yeah. Yes.
After all this happened the other day, you go to the local papers in these communities of Hal Rogers, etc. There were no stories on this. There were no anything on it. How can you take this from a Washington?
That's why we're here.
That's why you guys are here.
We're here. That you are.
Hello.
Look, we can understand a lot of things are going on. It's at one subcommittee among many. It didn't look like a lot of money, which is partly our point. But that's why we decided to get, frankly, a lot of fairly influential people to inconvenience themselves to come here, and in the hope that that gets done.
Congressman, you had said the other day that you thought the president didn't ask for enough money for the CFTC and
right.
SEC. What should he have asked for?
Oh, I would have gone for another $100 million, but at a time when they're not giving him what he asked for, I suppose to some extent that's an academic question. And I have my own personal views about how we should spend money, but I understand that's not before us. I think that, and there is actually I was thinking more there with the SEC. He's proposed a significant increase for the CFTC. Ideally, I would like the CFTC to be much larger, but you can't get there right away. I understand that. And there's no point pretending that you can double the size of an agency like that. Let me just reinforce the point that Gene Gilbert made about the 15,000 comments. Under the Administrative Procedures Act, the SEC, the CFTC, any of the agencies are mandated to read every comment, and when they are challenged in court by these deep-pocketed financial institutions, demonstrate that they did analyze the comments and have responded to them. So it is a filibuster against the regulation. We're not trying to cut off anybody's right to make the comments, but we do want to have enough staff so that that does not become a de facto way to kill the process.
Barney?
Yes.
On the comment, this is not and I say this to the press, it's not a process issue. It's not whether or not the president should have asked for more or less. The president asked for 41% more than we're getting. This is about the substance. Tell the story about the substance. Listen to Brooks Born. Listen to Gene Guilford if you do not want to listen to us. And understand the substance of what's happening here. That this agency, which has the fundamental responsibility for overseeing the regulation of an industry that brought this country to its knees, is now being starved of resources by the Republican majority in this body because of who they support and what they want to do, because they don't believe in the regulation, they believe in the support of Wall Street, and they believe ultimately that the American people should get screwed.
And I have to clarify too, because I now recall that comment. A 41% increase is a big increase. I'm skeptical that you could assimilate more than that. My comment was with regard to the SEC, not the CFTC, if you remember, because it came at the hearing on an SRO, which dealt with the SEC. The SEC is a bigger agency, and I think they could have accommodated a bigger increase. With the CFTC, it would be a mistake to pretend that more than a 41% could be assimilated. Questions?
Gary Gensler's term expired in April. How difficult do you think it would be for him to be reconfirmed in the Senate?
Well, given the Senate filibuster rule, probably very difficult. One of the ways the Senate has interfered with the implementation of the bill is by refusing to confirm or delaying confirmations. So my guess is that you would find Republican opposition to a confirmation, and that's the problem.
In our committee, the cuts generally range from 7 to 10%. So this was 41% reduction, was way out of line with anything that was done in any other budget.
Congressman Frank, Gary Gensler said that the losses of J.P. Morgan demonstrate the need to regulate foreign branches of U.S. banks. You expressed some concern about that before. What do you think?
Oh no, I expressed concern about it if it was not tempered. But we did oppose a Republican bill. Remember, the Republicans passed a bill in the Financial Services Committee to deregulate precisely the activity of J.P. Morgan. And we had an amendment that all Democrats supported that said there needs to be a residual capacity. We're prepared to let our regulators defer if there's good regulation elsewhere. But we oppose this notion, and in fact, we're able to block the bill. And by the way, the bill was scheduled to be voted on in the Agriculture Committee, and after the J.P. Morgan Chase, it got pulled. But I'm glad for that question, because I want to stress one aspect of the J.P. Morgan Chase debate. A lot has been done about the Volcker Rule, and that's important. But it would not be enough simply to have a tough enforcement of the Volcker Rule and say that this kind of activity couldn't be done in a bank and then have it under-regulated elsewhere. AIG would not have been prevented by the Volcker Rule. And much of what we do in the bill, as Brooksley basically was telling you and others, as Ed Markey tried to do earlier, is to regulate derivative trading wherever it happens. So the debate that's triggered by J.P. Morgan Chase shouldn't simply be whether it's the Volcker Rule or not. It would not be a sufficient response. And that, by the way, applies to Glass-Steagall. Glass-Steagall would not have stopped what happened with AIG because Glass-Steagall never heard of derivatives. The key point here is that derivatives are very dangerous. Let me make this point about derivatives. J.P. Morgan Chase, people have said, is a well-run institution. I agree with that. I would be surprised if J.P. Morgan Chase would be getting a loss of this magnitude, it's about upwards of $3 billion now, in any other line of business. I don't think they would be losing $3 billion in their loan book. I don't think they'd be losing $3 billion in their asset management. I don't think they'd lose money underwriting IPOs to the extent they may do that. The only area of business of J.P. Morgan Chase where you got this kind of a loss had to do with derivatives. And that's the point that we are making, that derivative trading is obscure. It is so highly leveraged that you get these vast sums at risk. AIG, people said they don't know how much is at risk. Under our law, once it's fully implemented, they will. Ben Bernanke told Congress in September of 2008 that he was going to have to lend AIG $85 billion because they couldn't meet their payments. A week later, Hank Paulson says, by the way, we got to give them another $85 billion. Why? Because they had no idea how much they owed. So again, I ask people to analyze this. J.P. Morgan Chase, in my view, would not have encountered a loss in any other line of business. The fact that they could encounter a loss in the billions and counting in derivatives is why we need to regulate them, whether they're international or not.